welcome to It's the Economy. Despite a subpar non-farm payroll data, financial markets have actually veered to the view that the Fed will cut by 25 basis points only on September 18. That explains the sharp bounce back we saw in equities, US equities overnight, and also the dollar. Very important, the dollar index has actually jumped from sub 101 levels last Friday. You know, when the non-farm payrolls came, it was about 100.8, now to 101.7. So there are still three crucial data points before the FOMC meeting. The August US CPI data comes in tomorrow, Wednesday. On Thursday, we will get the PPI, Producer Price Index. And next week, we will get, just one day before the FOMC announcement, we get the retail sales data for August. All these are as much market moving. But a lot rides on the dollar. How much money foreign funds pump into emerging markets like India depends on how much they see the dollar weakening. So to discuss the currency and interest rate markets, how they are geared for the FOMC meet is Kamaksha Trivedi, Global Head FX Rates and EM Strategy at Goldman Sachs. Kamaksha, thank you very much indeed for joining us. You're a rare guest, probably because London is not appropriately suited in terms of time zones. But thank you for sparing time now.
Basically, how I here again.
Thank you. How are you all reading the mix of data? Is it just one cut, 25 basis in September and one each in November and December? Or do you think you cannot give up on more cuts, considering the weakness in the non-farm payrolls?
I think, successive cuts of 25 basis points for the next three meetings, I think that should be the baseline that you start with. That's very much our baseline. But I think as a number of Fed speakers made clear after the weak data that you were referring to on Friday, that, if you see further softness in the in any of the employment or activity indicators that are coming up either this month or next, I think that there would be a willingness to kind of front load or, move to somewhat bigger steps. I think that's appropriate given that inflation has largely cooled on a whole range of measures. And if you are operating with a dual mandate, one that is both targeting inflation and full employment and growth, that focus should shift to that growth side of the mandate. And so, if you have weaker data, there should be a willingness to move policy in bigger steps to make sure that that growth mandate is well protected. So I wouldn't rule out larger steps, and I think the market won't rule out larger steps even after a 25 basis point. I think some degree of pricing will remain in those November and December meetings.
Okay. Yeah, I guess much will depend on the CPI data as well that comes out later this week. What are you all going with? Just 0.2% month on month? And if that is delivered, then no change in expectation?
I think a little bit even less than that, I would say, but, rounded up to 0.2. But I think, I really do think that at this point, the inflation data, really in a big change relative to the last couple of years. I think the inflation data is now less important than the activity or the employment data that you're going to get. So, for example, the retail sales measure that you mentioned, the weekly jobless claims data that we get, I do think those are now going up in importance as the bigger risk the Fed faces now is less inflation resurgence, but more softening in growth and employment and a softening beyond what they would like to welcome. So I think the inflation data, the bar for it to really shift pricing one way or the other, I think is very high.
Well, that's very important, to tell us, to train our eyes as to what exactly is the data and how much weightage we should give. Though I was a little surprised that the market reacted not so badly to the labor data. After all, they had pulled down the previous months by 60,000 jobs in July and another 25,000 jobs in June. So it was quite a bad set of numbers. But Kamaksha, to the point where we really want from you, dollar index. I mean, if it is only three cuts, does the dollar index go below 100 by the time we get to December? Or are there a good chances it weakens even more?
Look, I think, the dollar index has already weakened a fair amount from its highs in, I would say middle of July. I think a lot of that reflects the fact that we're now pricing in cuts of almost, a cycle of cuts, not just 3 cuts, nearly 225 basis points for the entire cycle. And the fact that the Fed can and likely will, ease policy rates, ease real rates faster than many other jurisdictions, I think that is all consistent with the dollar index having moved lower. However, we are of the view that downside is limited from current levels, unless you see either, much more weakness in the U.S., which we don't expect, or a much stronger, growth view in the rest of the world, which remains to be seen.
Okay, at least with the DXY currencies, I guess Europe is not at least forecast to do much better than the US. If anything, it's the other way around. So let's come to the one where, the expectations are still of a hike in Japan. Are you all penciling in a hike? And is there a possibility of this yen carry trade again unraveling? That kind of a problem can come again, you think?
I think you're absolutely right in the first part of your question that, I think a lot of other places, other jurisdictions are not very different from the U.S. The euro area, the activity data look pretty weak as well. I would say, one of the underappreciated aspects of the Fed moving to a cutting cycle is that essentially cuts are going to come close to a central bank near you. You're going to see a wide range of central banks in the G10 and EM world moving to cuts now that the Fed is likely to give its green light. But Japan is in a different place. You mentioned that they are in a different part of their cycle. They are trying to gradually move rates higher after, a couple of decades of being at the lower bound and having had deflation. That journey is going to be a slow one, a patient one. We do expect, hikes, but only very gradually. And I think that shift is part of what, led to that kind of carry trade unwind. I think a good chunk of the tactical I'd say tactical carry strategy positioning has unwound, but a bigger chunk of the real money exposure to U.S. assets still remains.
Mm-hmm. Yeah, I would assume that lightning will not strike in the same place again. So another action replay of the same carry trade unraveling is perhaps unlikely. Okay, before I come to more of Asian questions, what about the U.S. yields? Do you think the 10-year is likely to be here, 3.7 to 4, or does it go outside this range?
I'd say under our baseline scenario that the U.S. economy can deliver a soft landing, that, we avoid recession, over the next 12 months. I'd say, yes, a range of between 3.5 to 4 seems like the right sort of level for the U.S. 10-year rate. I think going below that, does require you to price in those kind of bigger front-loaded cuts that I was talking about, and potentially those come in the event that growth data is even worse. I think if you start thinking properly about recession risk, that's the kind of thing that can get you to lower levels of the 10-year yield. On the flip side, again, I think that, given that the cuts are coming, given that you're likely to see a sequence of cuts and not just 1 or 2 or 3, it's hard to see, yields breaking that top side of the 4% level anytime soon.
Okay, got your range. Now let me come to an India question. I don't know how much this made a noise in fixed income circles, but the chief economic advisor, no less, raised his voice against inflation targeting framework itself. To be fair, he has done this in the past, but it became quite a debate. Is that finding any echo in when you take decisions? After all, the inflation targeting framework and keeping inflation below 6% has made us part of the bond index. I would think there have been some positive payoffs, but did you all even notice that debate?
Look, I think inflation targeting has served, many countries well. I think India is one of them. But I think there's always been an acknowledgement that inflation targeting was never, just a kind of one-size-fits-all. I mean, even if we were just talking about the U.S., they have a dual mandate. They, target both, stable prices and full employment. even other jurisdictions where you have inflation targeting, like the UK, that often comes with a range of flexibility around that to make sure that you're not just targeting inflation in so single-minded a fashion that you lose focus of the activity side and the growth side of things. And so I think there is, what we call inflation targeting. I think it's useful to have that as your lodestar. But I think, it's important and appropriate that each jurisdiction has a flexibility to achieve that in a way that is sensitive to local ground conditions. And I think that is true of India as well.
I would hold that India has been doing that. That's why it's called flexible inflation targeting. No, my limited point is, has it disturbed anyone? Or is India's loyalty to inflation less than we thought? No, it didn't make those ripples?
I don't think so. In fact, in my conversations with clients, India remains a destination that, people look upon fairly favorably from an investment standpoint. And I think part of that, is the stable policy framework that has been in place for many years.
Okay, good. Good if it didn't, because it's only an academic debate at this point, or so it seems. But today we saw someone taking a call on banks based on that argument, based on the debate. But what about the dollar rupee itself? We've got a fair amount of money coming in from bond indexes, funds, equity funds. Some of them are still on the sidelines. Active funds are not overweight India. How do you see the dollar rupee up to December, next 12 months?
Yeah, I mean, we have, over the next 3 months, a target of something like 84, not that far away from where we are right now. We have a modest amount of appreciation in the rupee and a modest amount of depreciation in the dollar penciled in as we go further out over the next 6 to 12 months to levels closer to 83 and a touch below that. Part of that reflects, the strong growth that you have in India, the high carry that is in the currency. And part of it reflects the fact that we have a modest amount of dollar depreciation penciled in over those 12 months' time. I think, the important thing from a rupee standpoint is not just the foreign inflows that are coming into India that you mentioned, from the bond index or from equity funds that might be covering their underweights. It's also, what is the policy framework and how much of that is allowed to affect the dollar rupee exchange rate and how much of that, ends up in, an expanding reserve, a reserve buffer and a reserve accumulation. Right. And so it's partly that policy dynamic that has made the rupee exchange rate a kind of very, very low volatility, very stable exchange rate.
Yes, well, absolutely. I don't think the Reserve Bank likes an appreciating rupee at all. Those who call currency manipulators can do what they like, but the Reserve Bank is very clear they don't want an appreciating currency, which is why it surprised me that you're saying even 83.5. I'm not sure the Reserve Bank likes that number. But just a final question: is it even in your debate that India could get a rating upgrade? After all, the fisc is. The fiscal deficit is coming down. Does that figure in your thinking? And therefore, where do you see bond yields, say, in the next 12 months in India?
Look, I think the prospect for bond yields is quite favorable over the next 12 months, but not just because of the fiscal side of things. I think there's a large amount of long-term savings products that are sort of going into that market. But equally, there is, the prospect of rate cuts, going back to what I was saying right at the top of this conversation about the Fed. I think the Fed that is, moving towards cuts is going to allow a lot of central banks, including central banks like India, to move rates lower. So I think, in India, government bonds are, one of our favored recommendations. We like that alongside the kind of stable carry that the rupee provides. I think it's a pretty attractive investment for a lot of people, even at the current rating level.
Okay, thank you very much. Just a word. What is the number you're looking at? Are you looking at 6.7 or something by December? And by 12 months from now, do the yields go to 6.5?
I think 6.5 is very achievable in 12 months.
Okay, that's good to hear. And I hope all the insurance guys and treasuries are listening to you. Thank you very much, Kamaksha, for sparing time for us. Pleasure speaking with you. Thank you. Well, that's it on this edition of Bazaar. Chartbusters coming up after a very quick break.